Welcome to Talk Tickers. So, Remax Holdings just dropped their Q2 numbers, and wow, the market's reaction? It was pretty rough. Let's dig into what happened, figure out why it happened, and of course, what you should be looking for going forward. So let's set the scene. On July 30th, the same day as their earnings call, the stock just plummeted. We're talking a close of down over 8.5%. And you can bet the market was watching. Volume shot up, and the message was loud and clear. Investors were not happy. But here's where it gets really interesting, right? This big sell-off happened even though RE/MAX actually beat their earnings expectations. I mean, their adjusted EPS came in about 10% higher than what Wall Street was looking for. So that begs the question, if the bottom line was solid, what on earth spooked investors so much? All right, let's get into it. It really is a tale of two tapes. On one hand, you've got the company doing a great job with cost control and expanding their margins. But on the other hand, well, there are some pretty clear signs that the top line, their revenue, is weakening. Okay, so when you look at the actual numbers, you can see this split plain as day. The adjusted EPS, 39 cents. That easily beat what analysts were expecting. And their adjusted EBITDA margins, they actually grew. But, and this is the big but, you gotta look at that top line. Revenue came in as $72.8 million, which missed by about 1%. More importantly, it was down over 7% compared to last year. And that right there is the signal of that core weakness. So a huge piece of this puzzle comes down to the agent count. I mean, for a business like Remax, the number of agents is basically its lifeblood. And what we saw this quarter was a real mixed bag. Some record highs, but also some pretty concerning lows. And you can be sure investors are zeroed in on this. Globally, things look fantastic. They hit a record 147,000 agents, which is amazing and really driven by their international growth. But back home in their most important market, the US and Canada, it's a different story. The agent count there dropped by 5% year over year. And believe me, that's the number that set off alarm bells for investors. Now, as you can imagine, management wasn't just going to sit there and take it. They pushed back on this idea pretty hard. The CEO, Eric Carlson, made it a point to highlight that their U.S. recruitment rates for April, May, and June were actually better than last year. So in their view, it's not a free fall. It's more like things are starting to stabilize. And they're trying to show this isn't just talk. Their strategy is, really surgical. They're not just out there buying up whatever they can. Instead, they're focused on these super high-value conversions. A perfect example is bringing a top brokerage in Hawaii with 170 agents into the Remax network. It's all about quality over quantity and grabbing market share, one important brokerage at a time.
Okay, so that brings us to their plans for the future. How are they going to reignite that growth? Well, management is betting big on a few new programs that they believe are the key to turning things around, especially in the US. The big one, their flagship initiative, is a program called Aspire. Think of it as a supercharged onboarding program for new agents. It combines education, tech, and a pretty unique financial model to help them get their business off the ground. This is their direct answer to that US agent count problem we were just talking about. And it seems to be catching on. The adoption rate has been really fast. We're talking nearly 60% of their US and Canada brokerages have already signed up. And management is pointing right to this, saying this is why those recruitment numbers are looking better. It really looks like the network is buying what they're selling. Now, Aspire isn't the whole story. They've also rolled out a new AI-powered referral system, which makes a ton of sense to leverage their huge global footprint. And they've got other stuff like a lead concierge service. There was one little weak spot, though. They have something called the Remax Media Network, and management was upfront about it. It's just ramping up a lot slower than they expected. And all of this brings us to the guidance, their outlook for the future. And honestly, this is the part that really mattered. This is where management's cautious tone just completely overshadowed that earnings beat and gave the market all the reason it needed to sell. So check this out, because it's another one of those contradictions. They actually raised their forecast for the full-year agent count. That's a big vote of confidence in the recruitment strategy. But the problem was on the money side. They tightened their guidance for revenue and profits, basically lowering the top end of what they expect to make. And that's what the market really latched onto. The CFO was really clear on the call about why they did this. She basically laid out 3 reasons. First, that media network we mentioned is just getting off the ground slower than planned. Second, the housing market is kind of soft, so they're expecting less from transaction-based fees. And third, the Aspire program, while great long-term, actually puts a little bit of pressure on revenue in the short term as it gets going.
So, where does that leave us? You've got these two competing stories, right? Operationally, they seem to be doing great, but that top line pressure is very real. So, what's our take here at Talk Tickers, and what should you be looking for in their next report? The whole debate for investors right now really boils down to one question. Can these new strategic initiatives, like Aspire and the new referral system, start working fast enough to fight against the headwinds from the slowing housing market? Because investor patience isn't infinite. They're doing a fantastic job on cost control, no doubt, but the market is screaming for top-line growth.
So, with all that in mind, we're giving this a market perform rating. Look, the company is executing really well on the things it can control. You just can't argue with 5 straight quarters of improving margins. But that top-line growth is just so challenged by the overall housing market, and that's going to put a cap on the stock's potential for now. All right, so what's a potential trade idea here? Well, one that reflects all this uncertainty might be a short straddle using options. The thinking is you could capture some premium if the stock just trades in a tight range while the market waits for more concrete proof. Then you could pair that with a long position in, say, a regional bank ETF. That kind of acts as a macro hedge, right? If the whole housing market and mortgage rates start to improve, that ETF should do well. So you're capturing that broader trend, even if Remax's own initiatives take a bit more time to really pay off. This is not financial advice.